wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This here is the Market Color Podcast, where we keep you informed on the latest developments in the global financial markets, and we do that by presenting you first with a broad overview of the global financial markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 162, and in this episode we're reviewing the performance of the global markets during the 22nd week of 2025, and that is from Monday the 26th to Friday the 30th of May. And without further ado, this is your host Jamhuri, and together let's dive right in. We kick it off in the United States, where, according to data released by the Commerce Department on Friday, inflation barely changed in the month of April as the tariffs implemented by President Trump at the beginning of the month had not yet transmitted through to consumer prices. The Personal Consumption Expenditures Price Index, which is the Federal Reserve's preferred measure of inflation, this increased by 2.1% on an annual basis, which was just a tad bit higher than the Fed's target rate of 2%. Meanwhile, the core rate of inflation, which excludes food and energy prices and is a better indicator of longer-term inflation trends, this came out at 2.5% vis-a-vis market expectations of 2.6%. On Wall Street this past week, Friday's trading session marked the end of a strong trading month in May, with most of the performance attributed to the announcement of a trade deal between the US and the UK, and with investors hoping for more trade agreements with other countries. The S&P 500 was little changed on Friday to close out a big winning month as investors shook off concerns about escalating trade tensions after President Trump said that China had violated its initial agreement with the US. The broad market index was up by 6.2% in the month of May and came to a close at 5,911, whilst the tech-heavy Nasdaq Composite surged by 9.6% during the same time to settle at 19,113, and the 30-stock Dow Jones Industrial Average gained by 3.9% during the month to finish off at 42,270. In the government bond market, the yield on the benchmark 10-year Treasury bond ticked down on Friday as investors digested the latest inflation data and considered the latest developments on President Trump's reciprocal tariffs. On Thursday, a federal appeals court granted the Trump administration's request to pause a ruling by a trade court that had struck down the introduction of reciprocal tariffs. And on Friday, President Trump claimed that China had violated its current agreement with the United States, and a Bloomberg report said that the Trump administration was considering broader restrictions on China's technology sector. In addition to that, the U.S. Treasury Secretary Scott Bessent has said that the ongoing trade talks between the U.S. and China were a bit stalled and may require the intervention of both presidents. In response to the foregoing, the yield on the 2-year Treasury note dipped by 2 basis points to close at 3.89%, whilst the yield on the longer-dated 10-year Treasury bond ticked lower by 3 basis points to settle at 4.39%. For your information, 1 basis point is equivalent to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude fell on Friday, driven by expectations that the Organization of Petroleum Exporting Countries may decide on Saturday to further boost oil production in the month of July above and beyond its previous forecasts. Prices dipped into negative territory on Friday after Reuters reported that OPEC was considering a further production increase in July, which is larger than the increase of 411,000 barrels per day that the group had previously decided for the months of May and June. This potential increase in oil output will add to the current global surplus of 2.2 million barrels per day and is likely to push prices even lower, with oil traders expecting prices to dip just below $60, and that is if OPEC decides to maintain the status quo on the supply side. In response, both benchmarks were down by more than 1% as the price of the global benchmark Brent crude came to a close at $63.93 a barrel, whilst the U.S. benchmark West Texas Intermediate crude settled at $60.73 per barrel. In the precious metals market, the price of gold slipped on Friday as the dollar edged higher and markets digested the latest tariff developments, whilst the softer inflation report suggests that a U.S. rate cut may still be on the cards. The Fed's preferred measure of inflation came in at 2.1% in April, which was just marginally above the Fed's target rate of 2%, which raised expectations that the U.S. Central Bank may cut interest rates as soon as September. Gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't provide a regular yield like a bond. This past week, the price of spot gold was down by 1.9% to finally settle at $3,293 per ounce. In the cryptocurrency market, the use of Bitcoin as a strategic asset on the balance sheet has helped lift the market capitalization of MicroStrategy to over $80 billion, and this strategy is now being copied by other multinational companies. MicroStrategy has now amassed a stake of about 600,000 bitcoins that is valued at over $60 billion, and the company's shares are now being used by investors as a proxy investment for Bitcoin. Michael Saylor, who is the current chairman of MicroStrategy and is a major advocate for Bitcoin, has said that over the long term, having Bitcoin on the balance sheet has proven to be extremely profitable. What began as a fringe financial asset is now becoming widely accepted in the financial markets and received a major boost from President Trump in March when he signed an executive order establishing a strategic Bitcoin reserve for the United States and in the process confirmed Bitcoin as a long-term store of value. We now change scene to the Kenyan financial markets, And we start by looking at the cost of living in the country, where during the past week, the Kenya National Bureau of Statistics released the latest inflation report, which showed that the annual rate of inflation for the month of May decreased to 3.8%, down from 4.1% in April. This headline rate of inflation was majorly driven by an increase in commodity prices, and with the rate of inflation now below the central bank's midpoint rate of 5%, we can expect the Monetary Policy Committee to continue easing its policy stance with a view to reducing the cost of credit and supporting economic activity. In the domestic foreign exchange market, during the past week, the Kenya shilling remained unchanged versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.26 compared to 129.23 that was recorded the previous week. Meanwhile, the sterling pound was priced at 173.63 and the euro was valued at 145.31. And on the regional front, one Kenya shilling was changing hands for 28.18 Ugandan shillings and 20.87 Tanzanian shillings, and to the Rwandese franc, it was posted at 10.94. The Kenya shilling continues to trade within a narrow range versus the US dollar, and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling remains negative, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased for the second week in a row and by a significant amount of $159 million for a grand total of $10.46 billion, which is equivalent to 4.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. Please note that in its weekly bulletin, the Central Bank of Kenya does not provide any explanation for the change in foreign exchange reserves. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and credit in the interbank market. The average interbank rate, which is the rate that banks use to lend to each other, mainly on an overnight basis, this was stable at 9.82% compared to a rate of 9.84% the previous week, and pretty much in line with the central bank rate at 10%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 15.8 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 29th of May, and the central bank received bids totaling to 55.1 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 229%. The central bank ended up accepting a total of 43.6 billion shillings, and the results of the auction were as follows. The 91-day rate declined by 3 basis points to average out at 8.29%, whilst the 182-day rate dipped by 1 basis point to settle at 8.56%, and the 364-day rate remained unchanged for the 5th week in a row at 10% flat. At the Nairobi Securities Exchange, during the month of May, the equities market was on an upward trajectory, with the NASI gaining the most by 6.4%, whilst the NSE 10, the NSE 25, and the NSE 20 gained by 4.9%, 3.6%, and 2.2% respectively. The stock market's positive performance was driven by gains recorded by large cap stocks such as Safaricom, Kenya Commercial Bank, and Cooperative Bank, which increased in value by 17.4%, 9.5%, and 7.6% respectively. This monthly performance was however weighed down by losses recorded by other large cap stocks such as Stanbic Bank, Standard Chartered Bank, and British American Tobacco, which declined by 12.9%, 10.5%, and 6.3% respectively. On Kenya's national debt, according to the latest data from the central bank, Kenya's national debt as at March 2025 stood at 11.3 trillion shillings, and this was divided between domestic debt, which stood at 6.1 trillion shillings, and foreign external debt that is valued at $40.5 billion, which is equivalent to 5.2 trillion shillings. For your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product, and given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue. And this week, we are looking at the World Bank's latest public finance review for Kenya. This public finance review for Kenya aims to ensure that every shilling in tax is used to benefit the Kenyan taxpayer and to inform the development of a fiscal policy that fosters job creation, poverty reduction, and equity. This review also explores options that look beyond the national budget with a view to leveraging fiscal and structural policies that can promote economic stability and growth, as well as job creation and poverty reduction, whilst at the same time improving governance in order to address the issue of corruption. Kenya's current fiscal situation is precarious to say the least, with public debt standing at 68% of the country's gross domestic product in 2024. Kenya is at a high risk of debt distress following the accumulation of expensive public debt over the past 10 to 15 years. This situation has been exacerbated by the tightening of global credit markets as dollar interest rates have risen, and this has escalated the cost of servicing this foreign external debt. The proposal by the Public Finance Review involves a fiscal consolidation strategy that combines interventions that simultaneously address the fiscal deficit and weak governance, as well as productivity and job creation. Beyond tackling key fiscal policy challenges such as domestic revenue mobilization, debt sustainability, and resource allocation, fiscal policy in Kenya needs to be part of a broader policy agenda for inclusive and sustainable economic development. This public finance review also explores policy measures that could reduce Kenya's debt to GDP ratio from the current level of 68% down to 44% within the next 10 years, that is by 2035. A reduction in capital expenditure is expected to support fiscal consolidation, but budget inefficiencies, high interest payments, and weak governance are hampering service delivery. However, reducing expenditure is going to be extremely difficult given that 53% of total revenues is already allocated to interest payments and another 33% is allocated to recurrent expenditure, which caters for salaries and pensions. These two items in the budget consume about 86% of total revenues, which leaves a little fiscal room for development and capital expenditure. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. For more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, when in doubt, go into the silence and listen to the still small voice within. Think about it. Thank you, and God bless.